you remember for previous topics, to answer the questions, I asked you to start with identifying what is the position of the person on the underlying asset, right? So if the concern, for example, suppose you want to hedge, right? If your concern, I'm talking about the previous topics, if your concern, for example, on crude palm oil, your concern on the crude palm oil is what happens if the price goes up, right? This means that you are short, right? You remember, you are short on crude palm oil because if the price goes up, you have a loss. And this means that you should long futures contract on crude palm oil, right? The same thing was for stock index futures. If your concern is what happens if the price goes down, right? In this case, this means that you are long and then you should short futures contract, right? But here is a different story, but the same concept, but you need to do some adjustments because here we are talking about interest rates, and interest rates, I mean, our main concern has a negative relationship with the underlying asset price. So if your concern is if interest rate goes up, I will have a loss. This means that your concern is if debt instrument, this should be debt instrument, right? If debt instrument price goes down. So look at this. If my concern is what happens if interest rate goes up, this means my concern is what happens if debt instrument price goes down. This means that this is about the underlying asset, right? This means that you are long on the underlying asset. So you should short or you should sell futures contract. And short or selling futures contract means borrowing. Why? Because the underlying asset, I mean, these contracts are all about debt instruments. And when you short debt instruments or you sell debt instruments, this is like borrowing. You remember from our topics from previous subjects about bonds or debt instruments, when you issue or short or sell a debt instrument, this means that you are borrowing. You sell a debt instrument in the market and you receive money, so you are borrowing. So again, if your concern is what happens if price goes up, I will have a loss if the if your concern is I will have a loss if interest rate goes up, this means that you will have a loss if debt instruments price goes down. This means that you are long on the underlying asset. This means you should short or sell futures contract to hedge. And short or selling futures, financial futures contracts is like borrowing. It's actually the same thing as borrowing. Now, if my concern is I will have a loss if the interest rate goes down, this is translated to I will have a loss if debt instrument value goes up, means I will have a loss if the underlying asset price goes up. And if my concern is I will have a loss if underlying asset price goes up, this means that I'm short on the underlying asset, on the debt instrument. This means I should long futures contract. I should long or I should buy financial futures. And buying or long debt instruments is same as lending money, right? When you go to the market for bonds, right? For bond market, you go to the market and buy a debt instrument. This means you're lending money to the issuer. So you need to understand this slide very well to be able to answer the questions.